responsibility and liability of auditors. So we'll be talking about 4 units in that in this chapter. We're looking at auditors' liability and the expectations gap. Then the second unit will be looking at fraud and error, international standards on auditing 240. We're looking at the auditor's liability. Also look at managing the auditor's liability. Then we close in this chapter. So it's a bit short, but then pay up attention because the examiner tests this regularly. In the last let's practice question we did, we noticed he tested some areas of this chapter 4. So by way of introduction, auditors face potential penalties for criminal offenses and legal claims for negligence. So in chapter 2, the regulatory environment, we saw cases where auditors were liable and they were fined, penalized for audit failures. So corporate crashes come with a lot of risks, and auditors are also liable, especially where they audit the books and at the end of the day the company is found to have issues that are really material. They will call back and say, where are the auditors? What happened? And they audited these books. Where are the internal? Where are the external? The external auditors carry more of the heavy blame. So auditors face these penalties and they need to be very careful. There's an audit expectation gap, which stands as the difference between the public perception of auditor duties and the actual legal professional requirements. So the audit expectation gap talks about the difference between what the public sees as auditors' duties and what professionally in practice are what we are supposed to carry out or required to do as auditors. So there's an expectation gap between the public and our professional practice framework. This is very important. So,
excuse me, sir. When you say public, when you say public, what do you mean public? Do you mean the shareholders or the general public that don't have any business with auditors, or the layman or the illiterate man, or who is the public?
Okay, so we're looking at clients, people that call for our services. So there's an expectation from the clients. Yes, so we are to serve the public interest. Yes, our clients. So we have to serve the public interest, and before we are giving jobs as auditors, especially those in external audit firms, there's a perception of our duties from afar, and also when we take up the engagement. And there's also what we are supposed to do, we are required to do in professional practice, and that's what expectation gap is all about. So in answering your question succinctly, the public expectation is mostly potential clients or actual clients. Yeah. So please feel free to interject if you don't understand any terms. Thank you for that, Julie. I used to have issues with that expectation gap when I was writing. I didn't understand it until I started practicing internal audit. So it's actually challenging. Yes, most people in financial reporting find it challenging, but when they come into the practice of internal or external audit, they tend to understand the terms practically. So please, whatever terms are ambiguous and a bit not clear, interject and let's speak to it as clear as possible as I understand. Yeah, so we have the audit expectation gap and we have the standards gap. And this standard gap talks about the perception of more prescriptive standards. So the international standards on auditing, if there's a gap in its understanding, the application is going to be terrible. If auditors have a challenge with applying those standards, even if they have knowledge of it, applying it in practice may lead to some liabilities if you don't apply them as they are supposed to be, depending on the industry, depending on the sector you are auditing. So the standard gaps are there, and auditors are vulnerable and liable to errors if there is a gap. So to bridge this gap, auditors need to ensure that they keep abreast the facts of the standards. So reading the standards over and over again in professional practice is very important. The international standards on auditing, international standards on quality control, And all those standards are good to be reviewed over and over again. So the audit expectation gap, spoken about the standards gap, then we're speaking about the performance gap. And the performance gap is the perception that audit work is below standard. And that's performance gap. And that's as a result of lack of knowledge or professional upgrade, professional due care and competence. And that leads to a performance gap. The perception that the audit work is below standard. And those are all areas where could lead to auditors' liability and audit failures. There's also the liability gap, lack of understanding about the auditor's liability. So where auditors are penalized or fined for audit failures or issues, there's a gap there, especially when they don't know how to either go for insurance. Most audit firms are encouraged to insure their firm.
Sorry.
Yes,
excuse me. Now, you have mentioned 4 gaps now. Standard gap, performance gap, liability gap. And there's one you mentioned earlier. The first one.
Audit expectation gap. Audit expectation gap.
Okay.
Yes. So audit expectation gap, let me just run through it, is the gap between what your clients or potential clients and what you are actually supposed to do as requested in professional practice. So that's the gap of audit expectation. What your clients expect you to do and what you are actually supposed to do based on professional practice and what is legally enshrined in the ISAs for audit. And the standard gaps talk about the perception of more prescriptive standards and not knowing those standards and this application in the actual commencement or engagement of the audit work. Then performance gap is when you benchmark your work with the standards, the performance of it, the performance gap speaks to the perception that the work you've done in actual fact is below those standards. The liability gap talk about the lack of understanding about auditors' liability, especially where humans always audit. So if you say Big Four, it's not the Big Four that audit, that's a brand. There are human beings that work for the Big Four. So they are susceptible to failures, mistakes. So where audit mistakes are made, well, frameworks and regulatory authorities will carry the sledgehammer and hit it on their head. So instead of killing the firm or killing the engagement partner or the auditor, there's a gap that he may not know that he can insure against such, because the PCAOB in the US is a dangerous regulatory body. After the crash of Enron and WorldCom, if what did they call it? If PCAOB come after an engagement auditor, if they come after you, that there's perceived performance gap in you auditing a company in the US, most chartered accountants, they call them CPAs in the US. Once they hear PCAOB, it's called Public Complaints Accountants Board, Accountants Oversight Board in the US. Once you hear PCAOB are coming for you, man, you know what accountants do in the US? They flee, leave their license and they disappear. If you know there is a performance gap and you are sure they come and they find something, most chartered accountants leave, because if they find you culpable, it can be as bad as going to jail. That's how bad it is in the US because of corporate crashes like Enron and WorldCom. So the regulation is stricter in the US. So when you are doing audits in the US, man, you unturn any table. You make sure you do the job clear and have evidence so that anybody that comes, you'll be able to defend yourself. Why did you do this? You present evidence. Why? If you do it shabbily, just to get the audit fee or the money, man, if the regulatory authorities
are paid, they are paid good money.
Yes. Of course. Auditors, especially the Big Four. The Big Four get big money. Check their revenues or their books at the end of the year. They're always paid heavily because they negotiate better deals and because of the brand. So these gaps need to be extremely taken care of as auditors to avoid liability. And that is why this topic is on professional responsibility and the auditor's liability. So you need to avoid the audit expectation gap, understand it, and don't let it work against you. not just to pass the exams, but also in practice. Then the standards gap, the performance gap, and the liability gap. Make sure these gaps are bridged to ensure seamless auditing, and smarter auditors make sure they review this over and over again. They apply the safeguards and ensure that they are not found wanting in areas like this. So those are the 4 gaps, and I hope you...
I don't understand standard gaps.
Yes.
I don't understand standard gap.
Okay, so talking about the standards of auditing, every audit is supposed to be performed based on the international standards on auditing. So where you are supposed to benchmark your work, yes, you are benchmarking your work based on those standards, but the work is not actually done based on the standards. That's the perception of a gap. So a gap is looking at the sheet. There's a difference between what you are doing
and the standard.
And the standards.
Gap.
Exactly.
Okay.
Yes, the gap.
That is your pitfalls that are not meeting up to the standard gap. Okay.
Exactly.
Performance, what they expect from you are not meeting up to their expectation. Liability.
Yes, that lack of liability.
Okay, it's all right.
Yes, exactly. So liability gap talks about you performing, even if you are very good in auditing, have insurance. It's like not like Nigeria, where we don't really take insurance seriously. In the US, you cannot drive without insurance. So the same thing with auditing. You cannot have an audit firm and you are auditing without insurance, so that in case it's a risk management strategy, you are transferring the risk. If you're using TARA framework, the first method is transfer. So in most developed countries, it's not like here they tell you insurance, forget, I'm covered by the blood of Jesus. Though there's nothing like that in auditing, or they will tell you to go for liabilities.
But they work.
I know. It works. And that is why in risk management, we used to say, God forbid, it's not a risk management strategy. You cannot say God forbid. Yes, it's not a risk management strategy. They ask you, so you have to take insurance. And that's what liability gap is talking about. So in Nigeria, somebody will say he has an audit firm. I'm a Christian or I'm a Muslim. I don't do insurance. I believe in God. In actual practice, those are gaps. We don't pray for anything to happen, but if anything happens, man, an audit firm can shut down. And that is why these gaps need to be breached. Very important.
Okay.
Yeah. Okay, so let's move. Nice engagement. Thank you for that. So please bring it on. Let's engage. I love it. Okay, so it includes the misconception that auditors are responsible for detecting fraud. Yeah, so that's a misconception. Auditors are not primarily responsible. They are secondarily responsible. What do I mean by primarily? Auditors are not primarily or at the first engagement. Their terms of reference does not say you should detect fraud. But in the course of the work, if you find fraud, you have a responsibility to disclose or speak about it. And that's what this misconception is about. So when there's a fraud, later maybe it's discovered and auditors have audited the book. They say, but auditors have signed, they issued an unqualified opinion. Why is there fraud discovered? Primarily, their job is to issue an opinion and check whether systems of control work, or also vet the financial statement, but not to detect fraud primarily. But in the course of their work, if they find fraud, they should state it. So there's a misconception and auditors are held responsible. So if you don't know, they can just say, you are liable, you saw fraud, you didn't talk. It's possible you didn't see it. Yeah. And that's why we have fraud investigators. So when a company perceives there is fraud, they may not use auditors. They will ask fraud of investigators, specialists, forensic accountants to go and investigate. So this knowledge of what you are supposed to do and your responsibility, auditors that know this don't fall into traps by organizations or management trying to label auditors that they didn't do their job very well. Primarily, the job of management is to stop or ensure there is no fraud in their system. The job of external audit is to express an opinion, not to come and detect fraud. If you are employing him or engaging him to come and do fraud assessment or fraud investigation is a different engagement entirely. But in the review of financial statements, the annual statutory review, auditors are not primarily responsible for detecting fraud. So the consequences of expectation gaps, higher litigation, incorrect user decisions, distrust. Auditors need to close this gap, and knowledge and understanding auditing standards in the professional practice of auditing is very, very important in staying free. You understand your responsibility, what you are liable for and what you are not liable for. And that's what the chapter is about. So we need to improve the public understanding of audit processes by enhanced auditors' report. When there are strong controls over the profession, the international standards and oversight boards are very, very comfortable with our work. So strong controls over the auditing profession is guided by international standards of auditing. Then the oversight boards, like in the US, those ones are very, very strict. Man, those oversight boards, very dangerous people. And it started with Sarbanes-Oxley Act. That SOX Act, those two senators, Sarbanes and Oxley, they come up with very stringent rules, and they are rule-based. You cannot provide your judgment during audits. Follow the rules or you are in trouble. So we need to improve the understanding of audit processes to enhance our audit reports and the guidance for auditors and management to ensure that the company is a going concern. So we don't want liquidation, bankruptcy, and that's the essence of this. Audits should go seamless, should be okay, to ensure the company is a going concern. Its existence is in perpetuity. So open communication between auditors, management, and the audit committee is very important in addressing any challenge during audits. So also clear communication of rules, responsibilities in reports. In writing, like we advocate for, is very important. What are the responsibilities of auditors? What are the responsibilities of management? It should be clearly stated. Everybody should comprehend it and stay on your lane. Don't expect management to do auditors' work, and don't expect auditors to do management work. There will be confusion, so there should be synergy. Everybody should stay on his lane. Let there be seamless audit, and the going concern should ensue after the audit work.
Is this how to bridge the gap? This
yes,
how to
these
bridge
are
the gap.
areas to bridge the gap. Yes, these are the solutions to bridging those gaps. Exactly. So, like I spoke about, guidance for auditors, open communication, also clear communication in writing, very important. Also collaborative efforts between management and auditor to detect and deter fraud is also very important. Then success in these areas we've spoken about varies by region. So in our own region where we are IFRS compliant, the UK, Nigeria, and our jurisdiction, we may say we are recording more success than in the US, because corporate crashes in the US have made these areas of audit liability, responsibility more stricter. And that is why they apply the rule-based approach and we apply principle-based. In our region, we could use our judgment for some things. In the US, you don't use your judgment, you follow the book. If you are found wanting, you are in trouble. So audit committees also play a vital role in ensuring the auditor's responsibility is clear, and also the liability is minimized for auditors. Very important. So the International Audit and Assurance Standard Board have this Q&A. So as auditors, we should ask this question: professional skepticism. How skeptical are we in the auditing of financial statements? So we should ask this question in improving our responsibility and reducing our liability. Professional skepticism, we know, is having an inquiry mind, questioning. You don't accept as face value whatever is brought to you. The alertness to spot misstatements, material or immaterial, and ensuring you critically assess whatever evidence is provided to you. So that's what professional skepticism means. And to help address issues of liability, the International Audit and Assurance Standard Board said auditors should make sure they have these at the back of their mind, because it's crucial for identifying risks and responding very appropriately to fraud risk and other risks we encounter during audit engagements. It's also integral to internal auditor, internal auditor, integral to auditor skills and quality. This professional skepticism is key. It's influenced by the audit firm's culture, leadership, the training of the auditor, and the experience. So to reduce liability and understand more of the responsibility of the auditor, we need to have a firm's culture. There's a culture in KPMG that is different from PwC. There's a culture in PwC that is different from Deloitte, and there's a culture in Deloitte that is different from EY. Then looking at maybe the big five, BDO, PKF, all those big five, we call them big five or medium-sized audit firm. Everybody has a culture, but let the culture be driven by quality. Even if they are small, medium firms, and co, Josiah, Gabriel, and co, all those small firms, let quality drive the engagements. Very important. It's individuals that audit. The firm names don't audit. If you see maybe Anko, a small audit firm, and the chartered accountant is good, very experienced, he can do a good job than a big four where you see small children like me and Julie were speaking about. Some of these big four, they will send you small graduates that finish with 2-1 and first class. 2-1 and first class. And most of them don't know anything. They'll be asking you questions and be wondering, where is this one from? You know? So quality.
And they are the big four.
And they are the big four. Oh. So quality is driven by actually the firm's culture, leadership, the training and the experience somebody has gone through. And this helps fosters the quality of the audit and the bottom line, the outcome of audit reports. This is very important. So it's not about brand. Of course, those brands have good names, good experienced people, but then the quality and skills of the auditor, the person doing the work, is very paramount. So it's necessary throughout the audit process and the engagement, looking at acceptance of the engagement, then you're doing risk assessment before the work, performing either compliance procedures, testings before issuing the opinion is very important. So the process should be followed. None should be jumped based on assumption that, oh, okay, I'm used to the client, I'm familiar. Those could breed familiarity threats. So let the process be followed during audits, even if you are starting it year in, year out. So particularly important for fraud, complex judgment areas like estimates, IAS 37, going concern issues, related parties, IAS 28, evidence through discussions and documentation should be taken note of during audits to avoid auditors' liabilities. Also, regulators and governance bodies support skeptical behavior. So where auditors are skeptical, regulators support it. You will see situations where auditors will say, no, they don't agree with this bank posting. They don't agree with this judgment on performance and performing loan. And the thing will get to the SEC or to Financial Reporting Council, and the thing is a big issue. Some shareholders will even have to say, we don't want this auditor again, remove them, because they are too skeptical. Yeah, so regulatory bodies allow it where auditors are not comfortable. So they rather prefer their integrity and professional competence than the fee they are getting. You know, some auditors will look at the fee they get from a particular client and they won't want to talk. Just leave it, Jerry. As much as they are paying us our fee, leave it, let it go. Some auditors are very skeptical and stubborn. They will tell you, no, we'll not agree until this thing is changed. If it's not changed, we lose the work. We don't care. So regulators like that, and it fosters, yes, there are some obstinate auditors, very stubborn. Even though they are few, very stubborn. They don't care. Their reputation, their integrity is what they care about, which is paramount and very good for corporate.
And they are creating an impression, which is good.
Yes, of course. And
the big firm are not like that.
Some of them are like that. There are some that are like that. There was this case of EcoBank and which I think is Deloitte. They had issues with their performing and not performing. They so gave the management problem. The management reported them to the shareholders. Shareholders applied to SEC to remove them because they refused to bend on their position. So they removed them and replaced them with KPMG. Wow. And they had it on record that this was why they refused to change. So they were performing non-performing loans and they were saying that this was the value. And the auditors say, no, based on our assessment, this is not the value to be reported. And they stood on that, and the shareholders removed them. But then it's on record that they
they were obstinate about it.
Exactly, and that's the skeptical behavior that is good. So that's unit 1 on the auditor's liability and the expectation gap. So do we have any questions? I could see Rufiat, you're welcome. Aisha, you're welcome. I can see a lot of charts. Wow, beautiful. Beautiful.
Are they here? Good evening, Aisha, Rufiat. Who is the third person? Aisha, Rufiat.
Yes. Okay, it's Timothy.
Timothy,
yes. It's Aisha. You guys are welcome. Welcome to the call. Nice to have you. If you're speaking, you're muted. Yeah, welcome.
Good evening, everyone. Good evening, sir. Hello.
Yes, you're welcome.
Diana, Timothy. Good evening.
You're welcome.
Thank you.
You're welcome. Nice to have you. Nice to have you guys. Okay, so having understood auditor's liability and the expectation gap, let's run through fraud and error. We'll go through the auditor's liability and managing the auditor's liability also. Then we close this chapter. Okay, so for fraud and error, the international standards on auditing is 240. And for fraud and error, we need to be professionally competent and have due care. So competence comes by training and experience, and updates all the time. Due care is imbibed by exposure. You are exposed through knowledge, through standards. You understand what you're to do, and that's what it means to have due care. And competence is an upgrade. Every day you learn. The biggest room for an auditor or a chartered accountant is the room for improvement. Improve every day in your skills. That's why you are writing exams. You finish ICAN, you jump to CISA. You finish CISA, you jump to CIA. Aside just having those accolades, certificates, and all those acronyms tied to your name, BSc, MBA, MTM, CIA, these, all those are trash if you cannot demonstrate professional competence and due care. They are all trash. So the primary aim to have all those certifications is good. When you see some people's certifications on LinkedIn and their name, oh boy, you'll be intimidated. But then what's the value proposition? What do you bring to the table? Exactly. BSc, MSc, MBA, ACA, ACCA, this, that, fine. So this knowledge, does it culminate in application during the job?
I guess that's
Very
why
important.
Experience comes into play.
Exactly. So somebody will have all those certifications and he doesn't have any experience. Give him a job and he's confused. So professional competence is important and due care is gotten by experience. So we need to maintain knowledge, skill for competent service and act diligently and also follow standards. And it's a lifelong learning. There's no day we'll stop, except when we are retired or we stop audits or audit practice. It's lifelong learning. And in ICAN, every year you must have, that's why it's called mandatory continuous. You see that word, mandatory continuous program of education is very important. So every day you attend seminars. Day before yesterday, I was in a 2-credit seminar. What am I doing? Professional competence. Aside, okay, I can say you must have 40 credit units. That is 40 hours of knowledge every year. Structured, 15, unstructured, 25. Yes. If you are qualified, it's compulsory. That's why it's mandatory continuous.
Till you die.
If you don't have it, you can be delisted.
Till you die. How would they know if you don't have it?
Very good. So immediately you qualify, you have a number. And you are on ICAN's register and it's on the website. So if I type Julie as a chartered accountant anywhere in the world, I will see you as ICAN. And your number is there. So as you are paying your subscription, every year, as you are updating, you have a portal where those credits will be provided to you. So in your portal, you'll be seeing it that you are not getting upgraded and you are not learning daily. So it will be flagged to you.
So you key in all those new knowledge you are getting. You key in it in.
You don't even need to key it in. ICAN will key it in for you. Once you attend, automatically it will be updating on your portal.
Oh, immediately you have to attend for ICAN only.
Yes, for ICAN only. So ICAN have their structured and unstructured. So like national conference is 25 credit units. So once you attend national conference, with the knowledge you get, it updates automatically on your portal.
So they teach every conference.
Yes, it's mostly teaching, symposiums, interactions that are accounting driven, economy, different areas, financial, non-financial applications of our field. So every MCP, we call it, is resourceful. Yeah, please go ahead.
Okay. It's all right. No, is it me? I'm okay. I'm listening.
Oh, all right. So that's what enhances our professional care and competence. Then also the distinction between fraud and error is clear. Fraud is intentional act. They manipulate financial reporting. You did revenue of 2 million. Because the target is 4 million, you manipulate it to 4 million for that period. You misappropriate assets. Asset is not a particular value. You misappropriate it to show a robust position. That is fraud. But error is unintentional. You don't understand the policy and you applied it, or it was an oversight. A clerk made a mistake. He posted something on the ERP and you misinterpreted it, and it culminated in financial posting to the financial reports. So error is different from fraud, but then the consequences are almost most of the time the same. So one is intentional or unintentional, but then the result and the outcome is always disastrous, especially when it's material. So based on ISA 240, these are the difference between fraud and error. And most of the time, if a company crashes because of fraud or it crashes because of error, the penalties are mostly the same. It's almost the same. Some may provide lower reprimands, but then it culminates in the same issue at the end of the day. So what are the responsibility of management in our audit work? Prevention and detection of fraud and error. Primarily is the job of management. So they are responsible for that. Provide a true and fair view of your financial statement and install internal control systems and processes for your transactions. Primarily is for management. Then auditors, what's their job? Obtain reasonable assurance that the financial statements are free from a statement due to fraud or error. That's the job of the auditor. So if he finds fraud in the process of his work, he should state it to management, but not that something happens and they say, why did the auditor see fraud? It's management's job primarily. So if he didn't see it, it's not his fault. Except if it can be proven that he saw it.
Is it the work of the internal auditor? When you say management will not start doing all that, or is it their staff that should detect the fraud, or is the internal auditor?
Yeah, so the internal auditor also, in his internal audit charter, doesn't have a primary responsibility to detect fraud. What is internal audits? Internal audits provide assurance also that the system of internal controls, governance, risk management works. So primarily internal auditors and external auditors are not liable for fraud. But in the course of their duty, if they see fraud, they should. Why are they not liable? It's because they are independent of the processes. They did not install the process. So management installed the process. So they should know when there is fraud. So for example, in finance, the finance manager or the chief finance officer installed all the process from cash collection to recognition. So he should know from that system that this is where fraud, there are leakages. He knows. And most of them perpetrate it. So the auditor comes to check, okay, let's see whether from collection to recognition of revenue, you follow the process. If he sees that a process is not followed, he can flag. But management knows most of the time, and they are perpetrators most of the time. They know the process and they circumnavigate the process. They override the process. So mostly management are responsible for fraud because they installed it. So for example, you know the wiring in your house. A visitor can just come and you say, okay, look at the wiring, this. But he can just stay there for a while and look at the wire. But you live in that house, so you know what can go wrong. And that's the perfect picture of management and internal or external auditors. And that is why they say we should be independent and provide a review. So internal auditors that don't know this will go and be involving themselves with the process. I don't involve myself with process in your office. I can review and sign, but then I don't involve myself in the process. I need to be independent. Management, make your decisions, do your approval. If there is problem, it's you that will carry it on your head. That is it. I can flag and detect, but I'm not responsible for whatever you did. So it's very important. There's a dichotomy and understanding of our differences and our roles. So internal auditors provide internal assurance that things are working, and if it's not working, you flag it. External auditors, independent from outside, come on, because in the third line of defense, the Institute of Internal Auditors, 3 lines of defense model, internal and external audits are the third line. So they come to check and defend the company if there are issues that come to their attention. If management conceals it, hide the fraud, and it escalates, they are responsible. It's just that most of the time, if it's clear that the external auditors were supposed to detect it and they didn't detect, that's where penalties come in. So when external reviewers like the PCOB in the US come and see that these reviews the external auditors did and the internal auditors, they were supposed to see it now. So if it's clear that you saw it and you didn't talk, that's where liability comes in. So secondarily, you are liable. So that's what we are saying. Okay, so it's not primarily the responsibility of auditors to prevent and detect fraud. Inherent limitations mean some may go undetected. Exactly. You didn't install the system, so you may not know. And that's why it's good. Most internal auditors know. Yeah, they know when there's fraud, internal, because they are inside the system. But external auditors may not know. So internal auditors that have stayed 1, 2, 3 years, they know. I know some shady things that happen in my office, material and immaterial. I know. And I flag them because I'm in the system. So there may be some limitations, but I have some knowledge to what could go wrong, and I flag it to also protect myself during reviews and quality assurance programs. So auditors' procedure when suspected or when they suspect fraud is identify the extent and impact of the fraud and document it. Same for internal auditors. So identify the extent of the fraud, the impact, and document it. Consider impact on other audit areas, whatever fraud has affected. Maybe there's intentional manipulation of financial system to report a position that looks rosy. So look at where each of the accounts will affect other accounts in your assessment. Then you revise your plan if needed and call management's attention to it. So these procedures would help if there is suspected fraud in financial statements or the operations of a company. Then you need to discuss with management, keep them informed. Determine management's action after you've spoken about the fraud. Is it an error? Is it intentional? And did they remediate it? And that is why documentation is important. Communicate formally with the management, then take it to the audit committee. If the audit committee doesn't do anything, you take it to the board before you now go external. So there are processes to follow to report fraud and error. And after you've done everything possible, if nothing is done, you consider legal advice or resign if management intentionally is involved in this fraud. So consider impact on audit reports that you are supposed to provide an opinion on, the true and fair view, and consider reporting to authorities within your confidentiality duty. Yes, please. Yes, please.
He said, consider legal advice for examination if management. What do you mean by who is supposed to resign? Is it the management or you as the auditor?
Yes, the external audits, you can resign. So where management has demonstrated chronic irresponsibility, and you know it from the financial statement. So instead of sawing your hand, where they have obstinately said, no, we will not change this. This is what we chose to do. We resign from the engagement. Yeah, so there are some engagements you see this is not clear. You see the process to revenue for the particular period is 2 million. And management say, no, we decide to do 3 million. We can't change it. That is gross irresponsibility. So if management is obstinate, you can't stamp fraud. You resign and state your reason for it. And that's what it means. And where you are having issues with resigning, you can seek legal advice from a solicitor or a barrister to give you headway on it. But the best course of action in such situation where management has demonstrated gross lack of integrity is to resign. It's hard, especially maybe when the fee, when the large chunk of your fee is coming from a particular client. It's hard, but then you have to make that decision to retain your integrity. So looking at professional skepticism and fraud, maintain suitable skepticism. Discuss fraud possibility within the audit team. Also discuss management fraud prevention controls, what they have installed to prevent these frauds. Also identify fraud risks and evaluate the impact. Very important. Design procedures to obtain evidence about fraud occurrence. Yes. So it's important auditors do this to safeguard themselves and ensure that they are adequately clear that there is no fraud. So that if there's an external review, they will say, we saw this. How possible were you not to see this to flag it? So auditors need to safeguard themselves also to ensure that they are not liable. Okay, so let's run the next unit. If you don't have any question, thank you, Julie, for engaging. Please, others, feel free to engage. We're looking at the auditor's liability. Legal claims can be criminal, prosecution, or civil. Damages for negligence. Criminal liability examples include unqualified appointment, involvement in fraud, insider dealing. Yeah, auditors some involve themselves in this. They involve themselves in criminal things with management. Some can be compromised. It's true, there are cases of that. Some even get jobs, are appointed as auditors, and they are not qualified. But because of selfish interest, they go ahead and accept the job, and management appoint them for their own selfish interest. They involve themselves in fraud, insider dealing, they buy shares with the company, do a lot of shady things. So they are liable. Most of them are prosecuted in countries. They are even jailed for their actions. So offenses related to company winding up, taxes, tax issues, evasion, financial services, money laundering are very, very criminal offenses, and the auditors are involved. They are liable. They are liable to these criminal liabilities. Also civil liability, auditing anyhow, we don't even understand the standards. Negligence, it can also lead to claims under the contract law and the law of tort. So negligence is not an excuse. Why did you accept the job? So I don't know, I was not well informed. It's not an excuse. So auditors can be civilly liable. Under the contract law, a company can sue an auditor for breach of contract, and breach of contract will be negligence. Only the company has a standing to sue. The auditor's course duty of care is important. So you need to be careful, very, very careful. When they say duty of care, it's simple, be careful. Exercise reasonable care, diligence, and skill based on the Karma Act. Be careful. There are some engagements, some auditors will see, they will tell you they can't take it up. That's part of being careful. They will tell you, no, I don't want the job, give it to another person. Because from seeing preliminarily from the assessment, you know this is trouble. So following auditing standards is usually a defense, very important. ISAs will help you stay away from trouble. So liability in the law of tort, third parties, banks, creditors, shareholders, potential acquirers without a contract must use the tort law. So if you are not given a contract as an auditor, maybe out of negligence or you don't know, then the law of tort will apply. If anything goes wrong, the law takes over and you'll be judged according to the law of tort. And that's what.
So what's law of tort?
Okay, the law of tort is based on reasonable proceedings of what has happened. You are dealt with based on the law if there is no contract. So if a company crashes because of you, then the law will apply. Yes, the law will apply to deal with you, and that's what is called the law of tort. So where auditors don't do a job with contract or written representation, the law of tort applies when they are liable. Very important. So successful claim in the law of tort is you need to be careful. Again, auditors owe a duty of care to the plaintiff. The plaintiff is the person that took you to court. Most complex to establish. So be careful, be careful. And that's the meaning. Breach of duty. The auditor did not exercise reasonable care. And that's a challenge. If expert witness often shows this, then auditors are in trouble. They can go to jail. The law applies so that an auditor does not exempt you from most of the consequences of the actions. So auditors need to be careful. In the US, many auditors are in jail. So loss or damage that the company has suffered financially due to negligence, the auditor is also liable. In the law of tort, auditors are liable. So we need to establish the duty of care. In these cases, you can Google the cases, Headley, Bryan, and versus Keller and Partners. There's the ruling by the judge, he said inside 1964, duty owed to third parties known by name who relied on auditor's work shows that the auditor is liable. So this is not even the client, third parties that relied on the auditor's work and the auditor failed them shows the auditor is liable. So you can Google this case. I'll share this slide to just read through what happened.
It's 1964.
Yeah, since 1964. So these are set the precedents since 1964. It's not today. Auditors have been have been compromised. It has started long immemorial. Auditors have been messing up most times. So it's not now. Before we were born, they have been messing up. So we need to set the record straight. Very important. Another case is Jeb Fasteners versus Mark Bloom in 1980. The case also ruled that duty is owed by the auditor, but no liability as the plaintiff would have proceeded anyway. So this case shows that, okay, the auditor is not liable because of the impact of the crash of the person's company or what the plaintiff went through. So the plaintiff can as well go on. So these two cases, there's another third case by Caparo Industries versus Dickman, 1989, is a leading case. Duty owed. The ruling was that duty not owed to potential investors, takeover, and bidders after they went to court. The auditor's role is to protect the company and inform shareholders about management and not aid investment decisions. So Caparo took Dickman to court that he was negligent and they made some investment decisions and lost. So the court ruled in favor of the auditor that no. You made decisions based on your instincts, not what the auditor did. He is to protect the company and not your investment. So these cases will help provide clarity on most of the responsibility and the liability the auditor is liable to. Also, you could seek out-of-court settlements by auditors to reduce the liability with the client. The advantages it saves cost and time. It avoids negative publicity and potential. When you settle out of court, there are unclear legal positions which may encourage claims insurance if you have it. So out-of-court settlement is encouraged for auditors to ensure that the liabilities and negative publicity that could close down the audit firm is reduced. Also, use of disclaimers is very important in auditor's report. Like in the case study, we'll tell you, use disclaimer. What does disclaimer mean? That, okay, these are the particular people that these reports are provided for. Any other person that uses it is on his own, so that you'll not be liable. So there's disclaimer of opinion, there is unqualified opinion, there's qualified opinion, and there's adverse opinion. So where you are not certain, please provide disclaimers as your audit conclusion. The purpose is to reduce third-party claims from people that are not primarily impacted by your report. It's not a guaranteed protection, but it's good to employ it most of the time. Use disclaimer of opinion if you are not sure of who is using your report. Very important. Okay, I think the time is 9 o'clock. So let me just run through this last, let me run through this last chapter so that when we come back from break, this one is short, managing the auditor's liability. We'll just review it and we'll come to chapter 5, please. I hope I'm allowed to do that.
Okay.
Okay. Thank you. Let me run through this. All right. Thank you. So let's manage the auditor's liability by understanding avoiding liability. To avoid unnecessary liability, please follow auditing standards. Use effective quality control. It's very important. The only way you cannot be liable is by knowing what you are doing. If an auditor knows what he's doing, he can't be liable. when he's taking up an engagement, he knows what he's doing. He knows what the standard says. He flags when he's supposed to flag. He lets go when he's supposed to let go. He knows materiality thresholds. He will avoid liability. And that's how to manage auditors' liability effectively. Make sure quality control standards are employed. Train staff appropriately. And that is why you cannot have an audit firm under ICAN if you have not trained under an audit firm for at least 3 years, so that you can understand the process. So for me now that I've not worked in an audit firm, I cannot take up external audit work, no matter the ACA, MBA, MTN, CISA, gather all the certifications in the world. If you don't have the experience, right? You cannot do it. You said?
Is that the standard? Is that the standard as in, is that what is required as in you cannot be an external auditor until you have worked in an internal audit firm? Is that what it's supposed to be?
Yes, in an external audit firm, you can't be an external auditor if you have not worked in an external audit firm for 3 years minimum in ICAN. So okay. If you like, have all the certifications, CIA, ACA, ACCA, you cannot work. You need that experience, and that is why Aisha said that's where experience comes in. You cannot buy experience. You have to learn. So that's a way to manage auditors' responsibility, and that is why staff train under audit firms. You stay updated with auditing methods. You meet professional claims. Engage in professional indemnity insurance. Most big audit firms and exposed audit firms go for insurance cover, which covers little liabilities, civil liabilities, not really criminal liabilities though, but in professional indemnity cover, insurance cover covers civil liabilities. So these are very important exposures. It's often required for professional bodies also like ICAN to do this, take all those indemnity insurance. And it has disadvantages. It may increase claims, encourage carelessness and high costs, but then it is encouraged to do it to avoid the auditor's liability. So if you have insurance, some people will increase their claims because they know you have insurance, especially in developed countries. But then, even if it will encourage recklessness, it's better to have the PII than not to have it at all. And it will increase the cost of operations also, because the insurance, we pay a premium every year. So it's a cost to the firm also, which some firms will want to avoid. Then also limiting liability, statutory limits on claims. That's the percentage of fee or fixed amounts. Agreement with clients to cap liability. That is allowed in some jurisdiction. There are agreements to cap the liability at a particular amount. So they need to limit the liability, especially when penalties are encroaching or are coming steering state at the face of the auditor. The claims are restricted to maybe the fee they pay the auditor or a fixed amount to help reduce the burden of the audits, especially when things go wrong. So limited liability partnerships for audit firms, the professional indemnity insurance for directors of client companies, and also disclaimer in audit reports will help to reduce the auditor's liabilities. This is very important and good to engage. Okay, so that's just a short way of looking at this. Before moving on to chapter 6, I believe we understand the expectation gap and how it arises in audits, the application of ISA 240 on fraud and error. We also understand it briefly, and we'll be able to describe the auditor's liability, both criminal. Criminal liabilities cannot be covered by insurance, only civil liability, and also explain how it could be managed. Okay, so that's a brief on professional responsibility and liability. So any question before we go on break, then we'll come back for our quiz.